Next important the investment alternative is insurance products. In recent days, the insurance gains more important among the people. Basically, the insurance is being taken by the people for protecting their life, protecting their belongingness. Basically, what we classify the insurance as the social device is going to reduce the uncertainties prevailing in the world. The insurance we can classify into the life insurance and non-life insurance. Specifically, what we can take the insurance here as an investment alternative, we can take the life insurance alone. So the life insurance which safeguard the person who wants to insure their life against the uncertainty. There are a number of uncertainties that have happened in the world. So it can be protected that particular person. Even anything happens to that particular person, sum of assured the amount will be paid to their dependents. So the financial risk can be eliminated while you are going to invest into the insurance, specifically the life insurance. Basic products of life insurance or basic the contracts under the life insurance we can divide into the traditional insurance contracts and unit linked insurance plans. So the insurance is basically a contract. Insurance is basically a long-term contract. No life insurance is being provided for short-term. Long-term, for example, of 5 years, 10 years, 15 years, 20, 25 years, even more than of that, the insurance contract can be created. So with that aspect, the life insurance contract can be classified as long-term contracts. And there are two basic products of life insurance. We call it as traditional insurance and unit-linked insurance plan. Whereas the traditional insurance you can take, it is basic insurance coverage is provided. Along with the coverage, the basic products of insurance, like for example of endowment. Endowment is providing a benefit if the policy holder alive at the time of maturity, the benefit only being provided. So basically the traditional policies has a component of term insurance and endowment assurance plan. Together the different types of plans are created under the traditional insurance plan. So the term insurance, during the specific term, during the specific policy term, the insurance coverage is provided to the person who have registered their life with the life insurance. So sum of insured amount can be provided in the event of a death or in the event any unforeseen event may happen. The uncertainty can be reduced in terms of taking term insurance. Along with that, the endowment assurance providing benefit only at the time of maturity. If the policyholder alives, the benefit will be provided to them. The endowment policies basically provides the bonus to the policyholders. The bonus is paid out of the profit generated by the insurance companies. So basically what the returns provided under the term insurance, or we can say it is traditional insurance policies, the returns are not guaranteed. So the traditional insurance policies, all the insurance, like you can take an example of endowment assurance plan or child plan or retirement benefit under the traditional plans, which are providing the bonus to the policy holders. The bonus is not paid immediately. The bonus will be paid along with the vested amount in his account, in his policy account. So basically the maturity benefit is provided, the sum of assured value plus vested bonus is being provided as a maturity benefit to the policy holder who have taken the insurance policy from the insurance company. The second important aspect is a ULIP, the unit linked insurance plan. The unit linked insurance plan is providing, along with the insurance coverage, along with the term insurance, whatever the value of money invested by the investor is being invested into the market linked with the units. As similar to the previous mutual fund, along with the mutual fund benefit, the insurance coverage is provided to the policy holders. That the benefit we call it as unit linked insurance plan. It is invested in the units, different types of units. Unit representing the equity, unit representing the debt, unit representing the money market. Different classes of asset in which the insurer has invested the money collected from the policy holders. So that plan we call it as unit linked insurance plan. Both the traditional policies as well as unit linked insurance policies are taken as the investment alternatives. There are some products which are being provided by the government. Can take the mandatory retirement schemes, voluntary retirement benefits. So the mandatory retirement schemes like statutory retirement schemes being offered by the business establishments like employee provident fund scheme. So employer contribution as well as employee contribution together is going to be created. The provident fund, the portion of salary is being deducted, and every month is going to be accumulated on the account of the employee who are working in the particular establishment. At the time of relieving or retirement, they can get the lump sum benefit out of this particular scheme. We call it as employee provident fund scheme. Employee pension scheme, after the retirement, they can get the benefit, they get the pension out of this particular scheme. Employee pension is being provided. The national pension scheme, apart from the employees, general public wants to get the fund after the retirement. During the work, maybe the people maybe worked in an organized sector. They want to secure their life after the retirement. They can have an option of national pension scheme in which they can able to make invest. They can able to invest during their work life. After the work life, after the retirement, they can get the benefit of pension with the frequency option selected by the person with the particular scheme. Gratuity is being provided to the employee who have been working in the organization for more than 5 years. The benefit is being provided. So these are the type of schemes are available to the people who are working in the organization. Voluntary retirement scheme, apart from this, there are a number of schemes are floated by the insurance companies. So Aditya Birla Insurance, Reliance Nippon Life Insurance, or you can take, there are different insurance companies are there in India. You can take the retirement product, retirement schemes with them, can be able to app the scheme and pay the premium, will get the benefit out of that. So these are the retirement products which are available. Real estate, the real asset investment is now very popular in it's the value is also increasing over the period of time compared to the financial assets. So the people are also, even traditional people or the people who wants to get some traditional value or go for some traditional values, the people are also wants to make invest into such kind of real estate, or we can say it is real assets they are going to invest. Investment in the residential house, buying of residential property, plots, that are going to be the value we can consider as the investment alternative. Buying of commercial property, shops, that going to be the real estate or agricultural land, holiday resorts, purchasing of them, and semi-urban land, buying it for the purpose of constructing the house in future. They can go for these options under the real estate. Precious objects investment, it is very popular in with that view. What we can have, the electronic objects are also familiar, like buying of e-gold. The investment point of view, there are different companies coming up with a different concept for inducing the investor to make investment into the market. The first one, precious metal investment. The people are tend to invest in gold and silver. Physically, they are purchasing the gold, purchasing of silvers. Precious stone investment, like for example, of investing in diamond, investing in other stones like ruby and other type of stones they are making investment in art objects and collectibles, rare collections, where they are going to make invest, like for example of tanjore painting, sculptures and antiques and other type of material. Even for a coin collection, stamp collection, the people are tend to make investment on that the collectible items. So these are the major investment alternatives are available to that the investor. So next, it is going to know about the elements of investment, or you can say it is criteria for evaluation. I'm going to make invest into the deposit schemes floated by the banks and financial institutions, or directly going to make invest into the shares, or I'm going to invest into the mutual funds, invest into the bonds, invest into the government securities, or invest into the real estate. Whatever it may be the investment, insurance you are going to invest. How these investment you are going to done? There are some criteria is suggested to evaluate the characteristics of investment avenues. So for that, the first one, rate of return, risk, marketability, tax shelter, and convenience are the major kind of things that are associated to evaluate the criteria for understanding the characteristics of investment. The first one, the rate of return, the return given by the particular investment. So the rate of return can be classified into current yield and capital appreciation. The current yield is a return given by the particular asset by using the asset, the returns generated. Whatever the return generated by using the asset, we can classify as current return. During the specific period of time, whatever the return generated by the particular asset. The capital appreciation is a difference between the buying price and the selling price in the market. That you can take an example of a housing property. You have purchased a housing property for 50 lakhs and you have rendered that particular property with 15,000 rupees per month. After 3 years, you would like to sell that particular house in the market. At the time, the value of that particular residential property is 65 lakhs. So here, what is the current income generated by the particular asset? I have let out that particular asset, rented that particular asset for 15,000 rupees per month. So benefit what I have received on that particular asset per month, 15,000 rupees. It is 1,80,000 rupee per year. It is going to be the 5,45,000 for the 3 years of time, 40,000. And selling that particular asset, purchased it for 50 lakhs and sell it in the market for 65 lakhs. 15 lakhs return I have generated. This return, what I can call it as capital appreciation. So the capital appreciation of 15 lakhs, current return of 5,40,000 rupees. So together 20 lakh 40,000 rupee I have generated a return out of this particular asset. So it is about the return what I have generated, the 40% of return what I have generated from that particular asset, that we can call it as the rate of return. The risk associated with the investment, it is in terms the return generated, the variance in return can be calculated. The standard deviation, it is how it is deviated from the average rate of return given by that particular asset over the period of time. And the beta is the systematic risk calculation. It compares the risk generated by the particular asset corresponding to the market risk. So the covariance of risk is being measured by using the beta. So totally what the risk component statistical tools is being used for the purpose of evaluating the characteristics of investment. Next one, marketability. The marketability is about the transaction, how it is transacted quickly, transaction cost to be a low and the price changes to be a negligible over the period of time. Then only that particular asset has a marketability. purchase that particular property for 50 lakhs after the period of time. After 3 years of time, I'm going to sell it in the market for 65 lakhs. It means at least the 30% of return I have generated for buying and selling of asset. Rented that particular asset, I have generated the additional 10% of return. So together the 40% of return I have generated. It is about profitability. And transact quickly, efficiently, effectively, it is going to be transacted. The transaction cost to be a low and the price changes to be a negligible or the characteristics of marketability. So if I'm going to buy that particular, making investment on that particular share, how effectively I can be able to sell it in the market. It took a period of time. It has been taken 1 year of time, 2 years of time. The investor is deciding that the factor, it cannot be easily transacted. The liquidity level of that particular asset is low. For example, of a residential property, if you are buying and selling the residential property, it is not easy task. It will not going to be sell it in the market for a week time. It may be taken for a month time or maybe for a year time required for selling that particular asset in the market. So it cannot be happen on the overnight period. So that is what the liquidity level is low. The transaction cost we can take, whereas the transaction cost is also high. According to the Registration Act, at least you need to pay some 11% for the documentation charges. The transaction charges are heavy. So not like can be easily sell it in the market. Even though the investment, the prices are to be high, you can able to get the higher rate of return for making such investment into the real assets. So like the way in which you are going to make investment, what are the investment objectives or the alternatives you are expecting from your investment, based on that the criteria can be followed. The tax shelter, what the purpose in which the investment are being done. Majority of them wants to make investment to get the tax exemption. Majority of the tax exemption you can be able to make invest into the national pension scheme or like the ATC investments, what we can say investment into the banks, investment into the post office for more than 5 years of deposits, ELSS scheme, equity linked saving schemes, insurance policies, purchasing of insurance policies together, that you can be able to claim maximum of 1,50,000 for making such investment into these investment alternatives. So the basically what the tax shelter is classified into three: initial tax benefit, continuing tax benefit, and terminal tax benefit. Initial tax benefit, at the time of investment, what exemption is being given to the investor for making investment into such investment alternative. If I have invested 1 lakh rupee into the bank for 5 years of more than 5 years of deposit scheme, I have been exempted. That limit of my income is exempted for the payment of tax. That is what we call it as initial tax benefit. Almost all the initial tax benefit that can be claimed under section 80C, 80CCC, 80D, the maximum tax benefit you can be able to claim with that under the initial tax benefit. Continuing tax benefit, there are some returns that you can be able to get out of that particular investment. Even you are making investment into the insurance policies, payment of premium, not only for the one particular year, it is going to be paid for a longer period of time, 5 years, 10 years, the tax benefit is being provided. Those tax benefit, what we call it as continuing tax benefit. You can be get the returns out of that investment. Like for example, you have made investment into equity. Equity has given a return of dividend. So what are the benefit is being provided? Tax benefit is being provided. The terminal tax benefit at the time of maturity. I'm going to retrieve the value of investment from the market. What is the benefit is being provided? Insurance policies are exempted under section 1010D of Income Tax Act. It is for the terminal tax benefit. You can be claimed out of that. Whatever the value of investment, the sum assured, vested bonus can be accumulated in your account, can be exempted for the payment of tax. So the tax shelter is going to be the initial tax benefit, continuing tax benefit, and terminal tax benefit are the major thing that comes under the category of tax shelter. So far I'm going to make invest, I'm going to look into these criteria for evaluating the investment alternative, like the convenience, like the procedure, legal formalities, maintenance. That going to be the major parameter the investor going to use that particular investment alternative. The procedure for making investment, like for example, you are going to buy the physical gold. It is easy compared to that you are going to make investment into insurance. There are formalities, there are procedures, there are legal formalities are associated with that. You need to give the age proof, address proof, identification proof. You can fill the proposal along with the supporting document, can be handed over to the insurer. Insurer will verify, insurer will the evaluate your proposal. If the age factor or other occupational factor or health conditions, they will call for the kind of medical checkup. So the kind of a procedure is tedious into the insurance, whereas the maintenance cost is also high. Once you are going to invest into insurance, there are different type of charges are being levied from the policy holder. Like at the time of enter into the insurance scheme, you can pay the allocation charges. It is going to be the administration charges. It is going to be the fund management charges. Different type of charges, mortality charges being levied from the policy holders. So likewise, if I am going to evaluate the investment alternative, I need to look into that different factors which are affecting the investment alternative. Even for a deposit schemes or insurance or mutual funds or direct investments into equities or even buying of derivatives from the market. Those things that you need to take the evaluation of investments. Next one, approaches to investment analysis. So you know that the investment is not for the specific period or a short period. It is meant for a longer period of time. So for the longer period of time, if I am going for an investment, what are the types of approaches can be taken into consideration, or what are the tools I can be used for the purpose of understanding, analyzing the characteristics of different investment alternatives. That is being given here as approaches to investment analysis. Basically for analyzing the investment, analyzing the characteristics of different investment alternative, there are three different types of analysis have been used. We call it as fundamental analysis, technical analysis, and efficient market hypothesis. The first one, fundamental analysis. The fundamental analysis is a basic evaluation being done by the investor to retrieve the intrinsic value of such securities which are traded in the market. What is intrinsic value? It's a fair value of security. How you can arrive or how you can derive the fair value of such securities in the market. The intrinsic value can be calculated. How to calculate the intrinsic value? There are a number of parameters being used for the calculation of intrinsic value. In this fundamental analysis have been used the three different approaches for extracting the intrinsic value. The first level of approach is called it as economic analysis. In this part of economic analysis, the investor is going to analyze the economic conditions which is prevailing on the specific country with respect to the macro level as well as to the micro level. Macro level analysis that consists of understanding the economy, understanding the development of economy, the growth of economy over the period of time. What is the level of price changes happens in that particular country over the period of time. The level of unemployment is prevailing on that particular country over the period of time is being understood for making investment on that particular country. So there are a number of economic indicators can be used for this particular purpose to know about what level that particular country is performing. Can be in the form of gross domestic product, gross national product, inflation prevailing in that particular country, personal income, personal disposable income, national income. The different types of indicator can be used for the purpose of calculating the movement of economy for a country. Specifically in the macroeconomic analysis, Within the macroeconomic analysis, there are different types of policies are being used by the government. Like we call it as macroeconomic policies. It's the fiscal policies, monetary policies, credit related changes. The things are to be comes under the category of macro analysis. Micro analysis is going to analyze the movement of the demand and supply prevailing in the market. The market related analysis, competition is prevailing in the market. So those things can be useful for understanding about the movement of economy. The economic analysis can be done. With that economic analysis, we can be able to understand that what are the industries performing well in that particular market. So economic analysis, for example, if one investor is going to invest in India, so they are understanding about the Indian economic conditions. After the Indian economic condition, they need to understand the industry's performance, industrial performance in that particular economy. What are the types of industries which are performing well in the market, like banking or automobile, or you can take the financial services industry, which industry is performing well. So in that industry, which companies are doing well, reasonably good, the financial condition of that particular company. So these things are to be evaluated in order to arrive the fair value of securities. We call it as intrinsic value. The second one is going to be the technical analysis for the specific period of time. You know that this the fundamental analysis took a time period for the valuation. It's a tedious process, time-consuming process. So the investor, irrespective of going fundamental analysis, they wants to make, or they wants to go for a technical analysis. So the technical analysis is a short-term predictor, short-term understanding of movement, short-term understanding of price changes that happens in the market over the period of time. That we call it as a technical analysis. So the technical analysis using the chart, using the price movement of that particular security over the period of time can be used for understanding where you are going to buy or sell. The kind of suggestion is being provided for the technical analysis. So basically the technical analysis is only using the charting techniques to understand that what level the price is being fixed for that particular security for the specific period of time. So based on that, the technical analysis is being used. The short-term prediction can be used for the investor who wants to invest for the short period of time. The next one is about the efficient market hypothesis. The efficient market hypothesis is understanding the efficiency of market. You know that how market prices are increasing, how market prices of such securities are decreasing in the market. It's based on the information, the intensity of information. So in this efficient market hypothesis is measuring the intensity of information, how information is quickly and effectively is making the changes of price for such securities which are listed or which are traded in the market. That we call it as efficient market hypothesis. It is about the assumption. What assumption the researcher is going to have? The researcher is going to have an assumption that how effectively, efficiently the information can be reflected or predicting the stock price in the market. That being used the efficient market hypothesis. Basically, the efficient market hypothesis can be classified into three. Efficient market hypothesis, we have three different stages. Weak form of efficiency, semi-strong form of efficiency, and strong form of efficiency. Whereas a weak form of efficiency, price related information, price and volume related information is being only taken, what we call it as market information. How market information is effective and efficient to measure the price of such security can be traded in the market, can be classified as weak form of efficiency. Without any fundamental, without any additional factors, it is only taken price and volume related data to predict the market price for the securities traded. That we call it as weak form of efficiency. Semi-strong form of efficiency, along with the market information, information related to the specific stock is taken. We call it as publicly available information. Along with the market information, public information is taken. It means, what is the public information? The information have been available for all the public in that the particular market. It has been reported in the newspaper or in the television channels. So with that particular information can be retrieved from the website with a free of cost. We call it as publicly available information. Strong form of efficiency can be classified as market related information along with the publicly available information. You can have a private information. The private information can be available for the specific group of people who are in that particular market, who are in that particular uh, association, industrial establishment. For example, who have opened account with Kotak Security. Kotak Security has specific team for analyzing the market, team of experts for analyzing the market. So they are going to give a report. That report is not available for the public. Though those reports are available for the group of people. It means like their customers who have opened a demat account from their securities, from their organization. So this we call it as the private information. So the efficient market hypothesis is measuring the efficiency of market into the three different forms, can be classified as weak form of efficiency, semi-strong form of efficiency, and strong form of efficiency. So that we call it as efficient market hypothesis is one of the major approach, can be used for evaluating the investment alternatives. Approaches to investment decision making. Different approaches being evaluated over the period of time. Approaches are classified for taking effective investment decision. Approaches are classified into fundamental approach, psychological approach, academic approach, and analytic approach. The fundamental approach is based on the fundamental factors about the economic factors, industrial factors, and company specific factors are the important factors for evaluating the relative worth of the stock in the market or relative worth of the securities in the market for making effective decision. So this is a basic thing that taken into the consideration for calculating the intrinsic value. So you all already aware what is intrinsic value. Intrinsic value is a real value of security. It's a fair value, fair price of that particular security which the investor would like to buy and sell it in the market. Investor would like to invest in the market at what price is being evaluated from the fundamental factors. So this fundamental factor is going to be identified from the fundamental approach. So the superior risk adjusted return can be get by the investor who wants to invest into the market. So here the investor is going to classify the securities as overvalued securities and undervalued securities. How the investor is going to find out the security is being overvalued or the securities is being undervalued? So the criteria is like the first one, overvalued securities. It is the intrinsic value of such security is less than the market price, or the market price of such security is higher than the intrinsic value. It is available in the market. So investor is going to buy that particular security at the higher price. So that we call it as the security is classified as overvalued securities. And next one is about the undervalued securities. Those securities which are relatively available at the cheaper cost, less than the fair value it is available in the market. The market price of such security is less than the intrinsic value. So those security we can classify as undervalued securities. So the classification is here, the overvalued securities and undervalued securities is compared with the current market price in which the securities are traded in the market. So if the case the intrinsic value is less than the market price, we consider it as undervalued securities. If that intrinsic value is being sold in the market based on the intrinsic value, we may classify as that intrinsic value is higher than the market price. We call it as it is undervalued securities. If that intrinsic value is less than the market price, we can call it as the securities are overvalued in nature. So that is a basic classification that can be taken into the fundamental approach. The fundamental approach are taken the fundamental factors. What are the fundamental factors? The fundamental factors are like economic factors, including gross domestic product, net domestic product, gross national product, net national product, personal income, personal disposable income, national income, everything, the rate of unemployment, the inflation rate, everything is being taken as a economic factors. Whereas the industrial factor, relative growth of the industry, sectoral growth, the period of time, and the company related factors like key financial ratios of the company, financial soundness of the company over the period of time. There are such factors are to be taken into the consideration for the calculation of fundamental analysis. So where the fundamental factors are guiding to arrive the intrinsic value of such securities. So those intrinsic value is being calculated, it being guide the investor to invest into the market. So it provide the basic stand. It provides the basic form in which the investor needs to understand whether the securities are overvalued or undervalued. When the investor is considering the securities are overvalued, if those intrinsic value of such security is less than the market price, it is classified as overvalued. And the undervalued securities, it means those intrinsic value is higher than the market price. It means it considered as the securities are undervalued. It is advised that the investor to make investment decision, overvalued stocks are advised to sell it in the market. Undervalued shares or undervalued securities are advised to buy it in the market. So this is a basic outcome from the fundamental approach. The second one, the psychological approach, where the psychological approach is not guided by any such factors like economic factor or industrial factor or company related factor. It is only the market performance of such stock along with the sentiment of the investor which guiding that the other investor to buy such stocks in the market, buy such securities in the market. That we call it as psychological approach, where the psychological approach stock prices are guided by the emotions rather than the reasons, rather than the information, rather than the analysis. Rather than that, the emotions are guiding the people to buy that particular security in the market. If those security prices are drastically increasing, investor is having knowledge, or investor wants to buy that particular stock with the intention that in future it is going to increase. And like it is profitable to understand how the investor would like to tend to behave in the market swap, the market movement. So based on the market condition, based on the market reaction, investor reaction is also tend to change. That going to be measured under the psychological approach, and the academic approach is based on the information, intensity of information, how the market is tend to change. So the market is reasonably efficient with respect to the flow of information into the market. The information available in the market, based on the information available in the market, how the market is tend to change, how the market prices are fluctuating, market prices of such securities are fluctuating in the market, is being identified from the academic approach. So the academic approach is identifying, academic approach is establishing that the market price is always equal. It means it is approximately, which may be equal to the fair value, or approximately it may equal to the intrinsic value of such securities that we traded in the market. So that we call it as academic approach. So the academic approach is basically taken from the efficient market hypothesis. You all already aware what is efficient market hypothesis. Efficient market hypothesis is going to test the market price. The market price is purely guided by the market information. So the market information is a source for the market price. So how effectively, quickly and effectively the market price are guided by the market information. So it is, you know that it is the weak form of efficiency, semi-strong form of efficiency, and the strong form of efficiency. The weak form of efficiency, market information. Market information means price and volume related data can guide the stock prices. That is, we consider normally as a weak form of efficiency without any fundamentals. It is going to take only the market price and volume related data to guide the price of forthcoming days. It is going to be the weak form of efficiency. Semi-strong form of efficiency. Along with that information, publicly available information. The information have been reported by the companies in the newspaper, reported by the companies in the television channels and other source of information. The information should be freely available to the public. We call it as public information. The private information is going to be the strong form of efficiency. The strong form of efficiency is measures how effectively the market related information, publicly available information and privately available information, how it is going to guide the market price. So here is a base. The information is a source which is going to identify the market price in this academic approach. And analytic approach is a combination of all these three approaches. So first, the analytic approach is taken the fundamental approach as a base. You can establish the value in which you are going to buy and sell the security. You can establish the base price for the security. For that, you are going to take a decision to buy the particular stock, or you are going to sell that particular stock in the market, or you are going to hold that particular stock in the market. For that, the particular purpose, what the price in which you are going to buy or what the price in which you are going to sell, you can be able to establish the analytic approach. In that, the fundamental factors are going to be identified. After identifying that, the prediction of market price, you can use the technical analysis. You can understand that whether the market is efficient or not by using the efficient market hypothesis. So the way in which the analytic approach can be used for the investment decision making. Source of financial information. You know that for taking investment decision, there are different source of information is needed. The efficient market hypothesis, you know that the price volume related information, publicly available information, private information is being used to test the market efficiency. So like for making investment by the investor is going to take the different information or different source of information is being gathered for taking effective investment decision. So with that, what are the major investment sources, or we can say the financial information, the sources of financial information? It is like the first one, world affairs. The current scenario is prevailing in the world. It's like the pandemic situation, how it is going to be the favorable for the investment decision. We can't say that the pandemic is going to be the unfavorable condition. For some sectors, it is going to be the favorable condition. So need to know that what happens around the world, the kind of crisis, the economic crisis is going on. So you need to know about what happens around the world. The first one is going to be the world affairs. The second one, domestic economic and political factors, what is going on in that particular country where you are going to make investment. If you are going to make investment in India, you need to know about the domestic economic condition. What is the gross domestic product? What is the gross national product of that particular country? National income, what is the revenue generation source of that particular country? The unemployment prevailing in that particular country, it is like you know that the inflation, you know the current inflation which was prevailing in India is about 9%. The consumer price index and the wholesale price index is about the 13%. So you need to understand that whether it is going to be the favorable or unfavorable if you are going to make investment in India. That the economic factors are basically guiding for such investment decision. The political stability or political factors, the kind of the schemes provided by the government may be favorable to that company or unfavorable to that industry is going to be analyzed. Industry information, specific information related to the industry, specific schemes given by the government to that particular industry, specific exemption given by the government to that particular industry, the growth of industry, the scope for further development. So the things are going to be the information that we can extract from the industry. The company information, it is about the financial information, non-financial information, or we can say it is strategic information related to that particular company over the period of time. Is going to understand about the various financial position of that particular company. It is like the liquidity position, solvency position of that particular company, profitability over the period of time. the turnover, marketability of that company, like everything is going to be analyzed from that part of the company information. The security market information about to understand the market condition with respect to the stock market, with respect to the investor behavior towards the stock market. It is with respect to that the market price movement. It is like how Sensex is going to volatile over the period of time. During that, if you are going for an investment, you need to analyze back how the stock prices or how the market prices or market behave during the last few years. You are going to analyze with respect to that the Sensex. You can take as index, benchmark index. You can take Nifty. Like those index, you can take into the consideration for measuring the market performance over the period of time, turnover of the market. Everything is going to be analyzed as a security market information. The security price quotation, in which the price it is available in the market. What is the last trading price? What is the weighted average market price of such security which are available in the market? The opening price of security, closing price of security during that particular day, trading day, how it is volatile, what is the high price and low price, the spread of that particular stock in that market over the period of time. This is for a day. You can take for the 52 weeks high, 52 weeks low price during the specific period of time, or during the 1 year, how this particular stock is volatile, how this particular security is volatile in the market. The security price quotation can be derived in order to understand that, in order to make investment on that particular security. It is like the date on related data related to the markets, data related to the mutual funds, data on new issue market, financial information. So the market related information related to the Sensex, related to the Nifty, related to the RBI rates, policy rates, credit policy, repo rate, reverse repo rate, marginal standing facilities, policy rates, bank rate, that you can take into the consideration. Like the mutual fund related information, going to make invest not only into the securities, not only directly into the buying of debt and equity. Respective of that, you are going for a diversification of investment. The choice is to be a mutual fund. So you are going to invest in mutual fund related data, NAV of that particular scheme over the period of time. NAV is about the net asset value. Net asset value is unit price of that particular stock in the market. And about the data on new issue market. The new issue market is what we call it as a primary market. So you know that the securities are being issued in the market. There are two markets the securities are being floated. The primary floating of securities, secondary floating of securities. Primary floating of securities, we call it as new issue market. We call it as a primary market. The fresh issuance of securities that happens in the market. The second one is going to be the secondary market, where already issued securities are again bought and sold in the market. We call it as secondary market, where the secondary market, the movement of secondary market, the issuance of securities is being taken care by the stock exchanges. So that the data related to the new issue market, it is like different methods in which the securities are floated into the market. Like for example, initial public offering, or when the company is going to issue at the very first time, they are going to mobilizing the capital from the public, they are going for initial public offering. The company is already established, the company has already issued IPO, again they are going to collect, again they are going to mobilize the capital from the market. They might be going for further public offering, or they don't want to go for public offer. Irrespective of that, they want to collect the capital, issue the capital to the existing shareholders. They might go for the option of right issue, and they may have the institutional option. Rather, they are going to approach the individual investor, they might go for the institutional investor. They might have an option of private placement and preferential allotment. Issue the capital, or the capital required for the company is being subscribed by the privately held companies, private placement. Or the qualified institutional buyers are going to buy the shares from your organization, or subscribe the securities from your organization, or contributing the required capital for your organization is being comes under the category of preferential allotment. Likewise, the new issue related information, related to the securities. Whereas mutual funds, it is going to be the NFO, new fund offer. The specific period is being opened for the closed-ended schemes. Whereas the open-ended scheme, it reminds anytime you can join, anytime you can withdraw your funds from the market, that can be possible. So it is about the new issue market. Next one is about the financial source of information, the financial information related to the financial market, related to the financial market conditions, related to the financial policies, the monetary policy of an economy. So those sources, we call it as financial information. Nature of investment analysis. Nature of investment analysis. They evaluate the securities market, measure the risk and returns, deal with the irreversible decisions, predict the future performance, shoots the investor's need. Or the nature of investment analysis. The investment analysis is basically to understand that the behavior of the market as well as the behavior of an investor. So how the investor is going to behave, the different investor requires different investment need. So those needs and wants, how it is going to be satisfied. You know that there are different investment alternatives, different investment products are to be offered. So with this, how it is going to be understand to suit the needs and wants of the investor to the specific investment avenues. So that going to be the nature of investment analysis. It is going to analyze, it is going to predict. Let's say, for example, if you are an investor, you want to take the high risk, you want to get the higher rate of return, that you might go for the option. You directly make investment into equities, or directly you may invest into the derivative products. That can be possible. You as an investor, aggressive investor, or else you are going to be the conservative investor. I don't want to take much risk. I just wanted to make invest into the market. You may have the option to make invest into the debentures. You may have an option to make invest into the deposit schemes floated by the bank financial institutions. Or else, if I want to make a kind of investment into the market, safely I want to invest. I just wanted to diversify my risk. You may have an option to make invest into the mutual funds. You know that the mutual fund is a vehicle for collecting investment from the investor, and that investment is not investing in one particular asset. It is going to invest in across the different class of asset. Across the different classes of asset, it is investing. So this, the kind of aggressive investor wants to take. So based on the requirement, it is going to understand what investor need is going to be matched with the investment avenue. So this particular process, we call it as investment analysis. So the nature of investment analysis first is going to analyze and evaluate the securities. So you know the meaning of securities. The term securities includes shares, debentures, bonds, and other instruments that can be traded in the market, that together included in the securities. A security is what we can classify into the marketable securities and non-marketable securities. Those securities which should have the price or can be tradable in the market, we can say the security is a marketable security. Those marketable security, the market price is applicable. Whereas a non-marketable securities, the market price is not applicable. Issuer can be redeem that particular instrument. Let's say, I just would like to say an example to understand what the marketable securities and non-marketable securities. Invest in equity share, invest in post office deposit schemes. Invest in equity share, you can buy from anyone and sell it in the market, sell it to anyone. That can be possible. It's prevailing on the market price. You can buy and sell it in the market. Whereas the post office deposit, you can buy it from the office which issued that particular deposit scheme, and you can redeem from the post office. There is no market price is applicable. So there should be a difference between the marketable securities and non-marketable securities. So basically, you need to evaluate the security. What exactly the security, the rate of return is going to be given. What is the nature of such security? The security may be a redeemable category or irredeemable category, marketable or non-marketable. So likewise, you need to understand, evaluate what are the criteria of that particular security. You need to understand the convenience of the security. You need to understand the relative marketability of the security, tax shelter of that particular security. So likewise, the key information related to the security is being evaluated. It's the first step involved in the investment analysis. The second one, you need to measure the risk and return associated with that particular instrument. The risk, that is a variation in return. Risk, it is uncertainty. Normally we call it as an uncertainty. In that, the investment point of view, we call it as the risk is the variation in return. You know that you have a residential property or a commercial property. With that property, you might receive a rental income of 15,000 rupees per month. It is going to be the constant over the period of time. But you are making investment into equity. With that equity shares, you might receive a dividend. During the first year, I have received a dividend of 100 rupees. Second year, I have received the dividend of 200 rupees. Third year, I have received the dividend of 50 rupees. So there is a variation in returns, variation in the price movement. So it is going to measure, or the concept we call it as a risk. The returns, you can classify the returns, the revenue generated from that particular instrument, either by holding the instrument or selling the instrument in the market. We can classify the returns into the current returns and the capital appreciation. The current return is going to be the return generated during the period of time, holding period of that particular instrument. What the entitlement of the investor to receive the income. And the capital appreciation is going to measure the price in which I have purchased that particular instrument and what price I am going to sell it in the market is going to be the returns I am going to calculate. Whereas the risk component we can take, risk is going to be classified into two major categories of risk or the types of risk: systematic risk and unsystematic risk. Systematic risk, how the risk of that security is in line with the market risk is going to be measured in the systematic risk. Unsystematic risk is a total risk associated with that particular instrument. We call it as, we can measure in the risk component. Deals with the irreversible decisions, because the investment, once you can make the investment, it cannot be reversed. Even it can be traded in the market, cannot be refunded, it cannot be reversed, that particular process. So that the decision to be taken properly while you are going to make the investment. And that the predicting the future performance, that going to be the important aspect. The past performance of that particular security. Based on that, you are going to evaluating the future prospect of that investment and suits the investor need, whether it is going to satisfy the investor requirement or not, what purpose you are going to make investment. I need to invest at the end of the investment period, or at the end of the 5 years or end of the 10 years, what the accumulated cash flow that you are expecting from that particular investment, what is the purpose you are making investment into the market. So that going to analyze the overall analysis, we call it as the investment analysis. The scope for investment analysis, what are the further scope we are going to make investment. The investment analysis is going to guiding for that, the purpose, the safety to the principal amount, what the amount is being contributed by the investor is to be protected. The second one is going to build a strong portfolio. It's going to be the diversification of risk. Risk adjusted return can be provided. It is going to be the frontier of securities. It can provide the lower risk with a higher rate of return. Is going to be the strong portfolio can enhance the return, the better return or the growth of return over the period of time. Import the financial knowledge to the investor, because different investment avenues, different investment characteristics, different evaluation criteria that you need to take for making investment into the market. For that, the particular purpose, the investor should aware, investor should know how to make investment into the market. Now, that's going to be the scope for investment analysis. Because why we are going for investment analysis, the reason behind that we need to go for investment analysis. The objectives of investment What are the major objectives of investment? The first one is a capital appreciation. The capital appreciation, you know that if I have invested 1 lakh rupee, currently it is the market price of such security is increasing the investment value of 1 lakh 50,000. For example, you have purchased a share for 100 rupees, it is prevailing in the market. You have purchased about the 1000 shares from that particular company. You have invested 1 lakh rupee. After the 1 year or after 1.5 years, it is going to be the 150 rupees in the market. You have purchased 1000 shares from that particular company. Your investment is going to increase from 1 lakh to 1 lakh 50,000. That we call it as a capital appreciation. Whatever the portion of investment that you have invested in that particular security is going to be increased from 1 lakh to 1 lakh 50,000. That we call it as a capital appreciation. The current income during the holding period, whatever the return is generated, by making investment into equity, you are entitled to receive the dividend. By making investment into preference shares, you are going to receive the fixed rate of dividend. By making investment into debenture, you are entitled to receive the interest. By making investment into the deposit schemes, you are entitled to receive the interest. By making investments into mutual funds, entitled to receive the current income out of that. By insurance, the bonus are accumulated, vested bonus to be accumulated your fund account. Likewise, what is the current income can be generated out of that particular investment. And capital preservation, how capital is going to be protected, safeguard that particular capital. Now, you know that there are different regulations of Securities Exchange Board of India is going to protect the capital that being contributed by the investor over the period of time. So the majority of the mutual fund schemes are aiming to protect the capital. For example of the SBI Magna Fund that provide the capital protection to that the investor who are making investment on that particular scheme. Likewise the insurance. So it is protecting, preserving the capital, at least whatever the fluctuations might be happens in the market. Like the safety to the investment and liquidity as then and there that the investment is going to be liquidated. The fund is required for the investor is going to get the benefit out of that. The transaction cost should be a low. So you know that the criteria when we can say the liquidity is high. The liquidity is high at the time it can be easily transacted, quickly transacted in the market. Second one, the transaction cost to be a low. For example, you have purchased the residential property. For that the residential property you are going to sell it in the market, it cannot be quickly sold it in the market. So the liquidity level is low, whereas you can take the equity shares or the derivatives you can take can be traded quickly in the market. They transacted quickly, that the instrument may have the highest amount of liquidity. So these are the purpose in which the investment is being done.